Hello friends, good morning. Today we are going to talk about calls and options. Now, you first let us discuss where calls and option falls in your syllabus. Okay. Calls and options is a part of chapter 5 of FM, Strategic Financial Management of CA Final. In chapter 5 it talks about capital instruments. That chapter is divided into 27 different subparts as per our module. Now, calls and options in one of these parts of our syllabus. Okay. To begin with calls and options, what is calls and options? First of all, let me tell you a brief idea, a bird's eye view of what we're going to learn in this chapter. Basically, calls and option is a type of derivative. Like you have futures, you have forward contracts. You must have heard, you may not be knowing about it as of now, but you must have heard about it. So calls and options is nothing but a derivative. Okay. So I will just write down 1 minute. Okay. Basically this chapter calls, puts, options. Call or put options. Okay. This chapter can be divided into two parts. Okay. One part is where simply you have to calculate the profit or the loss. Okay. And the other part is, so it has two branches. This chapter calls and call options and put options, they have two branches. One is you have to calculate the profit and loss, and the other part you have to calculate, or you have to derive at the value of the option. Value of the option. Okay. Today we are going to cover the first part, that is calculating the profit and loss, and first basic understanding of calls and options. Okay. Once we get an understanding, then later on we will talk about how we derive at the value of the premium, or how we derive at the value of the option. Okay. So as of now, let's focus on calculating the profit and loss, or how to enter a transaction of call and option. Okay. So before that, I'll just give you an idea what comes into deriving an option. So here we're going to learn calls and options. Calls, to buy a call option or something, you need premium. There's something called a premium. Okay. This premium, for now we will take it as an axiom. That is, where the value is coming from, we'll get from the sum. We'll not dig deep into it. For that we have the second part, that is deriving at the value of the option, in which again a lot of different types come. Different types of methods are there to value the option. Like there is Vega, Gamma, these are the small ones. Then there is binomial method, and there is Black-Scholes, which is very famous method. Okay, so these are the four options under the second part. This will be covered under. So today we are going to cover the calculate the profit and loss out of it. Okay, just a minute. Okay, I'm assuming every one of you all know what is stock. Everyone must have either invested or seen what is stock at this stage. So basically, a derivative is something which gets its value from the stock. Okay, and means if the stock price goes up, then the derivatives price will be impacted accordingly. Okay, so calls and options, call and put options are a type of derivative. Okay, so now you see options. Options are what? Option is basically where you have an option. It's like a right. You have a right, but you don't have an obligation. Okay, you have a right to purchase something. Okay, say you have apples or you have oranges. You have a right to purchase that apple or orange, but no one can force you. That is an option. That is why it is called an option, right? That is why it is called an option. So what do we do in a call option? In simple terms, like say we have, let's take a very famous share or stock market of the stock market, that is say Reliance, RIL. Okay, so what this will do is, Reliance at the current market price, I think it is around 870 rupees. Okay, so let's note it down, 870 rupees. Now what I will do is, now tomorrow I suppose I'm expecting, say my salary is going to come at the end of the month, so I'm expecting that say after 1 month I'm going to invest, I will be having investments of say rupees 10,000. I know I'm going to invest 10,000 rupees after 1 month. Okay, now if I have studied the Reliance stock properly, then what will happen, I will know, means through analysis, through my judgment and all, I will know that if it is 870 today, it has a possibility that after 1 month there is a possibility it will become 920 rupees, that is 50 rupees above what it is currently. Okay, so I am estimating that way, that the market price after 1 month will be 920 rupees. Okay, now everyone wants to buy the stock cheap, right? No one wants to pay extra money for the stock. So how we accomplish this? So basically, now since I have done my analysis, since I have superior knowledge, since I have asked my brokers or whatever, however I have gained the knowledge that tomorrow it is going to become 920 rupees after 1 month. Okay, so what I will do today, so that I lock the price at today's market price, like I want the Reliance share at 870 only after 1 month also. Okay, so what I will do, I will go to the derivatives market, I will buy a call option. Okay, now what is a call option basically? In call option is basically like, here what I will do now, call option in the sense, this 870 rupees, let's say this is the current market price, and let's say this is the let's say the what we can take as, we can take it as say 880 rupees. Okay, that is the what do you say, that is the our exercise price. Yeah, so 880 rupees is our exercise price. See, like what happens is, it can be 880, you will get it 870, you will get it 860, then you will get it 900 also. Okay, let's not complicate us, let's go for the exercise price is 880. Okay, so exercise price is 880 rupees and current market price is 872. So I buy a call option. Okay, when I'm buying a call option, I'm not buying a stock, remember that. So I will not have to pay for the stock. When I'm buying a call option, I am simply buying the right to buy that call. Okay, so someone, say this student, someone, suppose this student Rahul is sitting in front of me, so he's the seller of the option and I am the purchaser. I am buying the call option from him. Okay, so what he is essentially doing is, I have a right to demand the share from him after 1 month if I want. Okay, that is what I'm doing. So that is what a call option is basically. Okay, so say now Rahul, he will charge a premium for this service, he will not do it for free, right? That right he is giving me, that I can ask him anytime for that share. For that right he will charge a premium. Okay, let's say for simplicity's sake the premium is 20 rupees. Okay, per share now, or per call option basically. Call option is per share anyway, so let's say it is 20 rupees. Okay, now 880 plus 20, I will not have to pay 900, I have to pay 20 rupees today. Okay, 20 rupees I will pay today to lock my call. Okay, that is called buying the call basically. Okay, 20 rupees I paid today. So my net outflow of cash, net outflow is 20 rupees. That is my premium today, if you can see over here. I'm not sure it's clear, but yeah, net outflow is 20 rupees. Okay, now chalo. Now let's close our eyes and then future, flashback in the future, fast forward basically. Okay, now you're 1 month ahead. Okay, so today is say, now you're suddenly in November, 21st November. Okay, now on 21st November what will happen first? Okay, I'll just 1 minute in my pen so that it's more clear. So on 21st November what happens? That is, I get my salary that day. Okay, out of that, a small savings, humble savings of 10,000 rupees I want to make, for which I had decided 1 month back that I will put in Reliance shares. Okay, I see the current market price of Reliance, okay, has gone up to 1,000 rupees. Can you believe that? It has gone up to 1,000 rupees. Now, if I was a normal layman, what would have happened? I would have to purchase this Reliance share at 1,000 rupees, right? Whereas I knew before only that it is 870. That time at 870 only I knew that this stock will go up. But that time I didn't have money, so I couldn't buy. So now at 1,000 rupees, what is happening at 1,000 rupees? I'm feeling I've made a big loss. Why? Because I could have invested at 870 rupees only, but I have to now pay 1,000 rupees. Okay. So anyways, how I would have basically got less number of shares. Basically, if I would have gone for the market price, right, I would have got less number of shares. So now what will happen is, it's 1,000 rupees. Okay, now because I have the call option, I'll show you how this call option works. Basically, how this call option is in the sense of acting as an insurance, right? I'll show you how. See now. So I had this call option with Rahul. Okay, so now Rahul, what he will do, I will go to the market, I'll see it is 1,000 rupees. Then I will go to Rahul. I will think, I will look at the contract. I'll say my exercise price is 880 rupees. Okay, that means I can tell Rahul, I can go to his house, I can tell him that you sell me the share for 880 rupees. Although the share is 1,000 rupees today in the market. But because I had already have this contract with you, I had taken this option with you, I had paid premium also to you, so you sell me the share for 880 rupees. Okay, and he has to sell it. Okay, so I see what my profit is over here. 800 and what I'm doing that day essentially on 21st November is 1,000 rupees is the market price minus 880 rupees. Okay, that is 120 rupees. You will think this is notional. No, it is not even notional profit. It is real profit coming into your hands. How I'll tell you. I will buy at cheaper and I will sell more expensive in the market. I will buy from Rahul at 880 rupees, and that same day I'm selling for 1,000 rupees. So in one day I'm getting 120 rupees profit. Okay. There are some mechanism involved, the stock market, how it runs and all, but this is the basic thing. Like, I'm purchasing low and I'm selling high, and it's happening in the same day. This is what call option does for you. Okay, so now my profit was 120 rupees. Now this 120 rupees, from that you minus 20 rupees which I paid earlier 1 month back as premium. 100 rupees is your net profit. Okay, 100 rupees. Okay, so now this is basically the idea of a call option. In this we saw that how call option acts like an insurance basically. Okay, now we are going to look at another situation. Okay, in this situation what happens? Just give me a minute. Just have some water. Yes, back to square. So now on 21st November again we are that same day. Now forget about the 1000, right? Now we are again back. We went to October. I bought the share. I bought the call option. We came back to November now. Instead of the price being 1000 rupees today, the current market price on 21st November being 1000 rupees, the stock markets have performed bad in the 1 month. the price has gone down to, let's say, 500 rupees. It has crashed. The stock market has crashed. The price of Reliance has gone down from 870 rupees to 500 rupees. Okay, so now we will see why it has gone to 500 rupees. What is the impact on the call option? Okay, now see, I am getting the share in the market. First of all, I am determined that I want Reliance because I want for long term. Okay, so I want to buy. So now I am getting in the market for 500 rupees. And when I go to Rahul, the exercise price, that is the contract price, that is the exercise price, is 880 rupees. So which fool will buy the same thing for more expensive? Will you buy Apple for 80 rupees when you're getting 40 rupees? No, you will not buy. Similarly, in Reliance out here, I will buy directly from the market at 500 rupees. Why will I buy from Rahul? Why will I tell him that you give me the share? Okay. Now, here the important part comes. Like I said, an option, it is a right, but it is not an obligation. Rahul cannot come to me and say that you have to buy the share at 880 rupees. No, that is not, he doesn't have the right. I have the right to demand the share from him. He doesn't have a corresponding right to sell the share to me. Okay. So in this case, what happens? This option is called basically out of the money option. Okay, and the one we did previously, that was in the money option. Out of the money means this option expires. Basically, I will not exercise the option, right? So validity gets over, it will get over, right? There will be no contract. What will be my loss in this? My maximum loss will be 20 rupees. How 20 rupees? It is a premium that I paid earlier. Okay, so this is as you can see, there's no loss in this, in the sense, just give me a minute. There's no, yeah, charger went off. Anyways, so there is no loss to me in this case. Okay, like you will say there's a notional loss. There's nothing, no notional loss, nothing like this. 20 rupees is what the outflow was, and that will always remain the outflow. Okay, you don't go ahead and calculate 880 minus 500. That is not in the picture only. I'm not exercising the option. Okay, so to summarize, what we see is a call option. It is acting like an insurance. Okay, say a health insurance. You pay a premium in the beginning of the year, 2,500 or whatever I pay. That is the amount I think you pay. 2,500 rupees you pay. Now in the full year, if you fall sick, you will get 2.5 lakh rupees coverage, right? And if you don't fall sick, then what will happen? The next year again you will have to renew. That means it will expire. Okay, and that is the maximum loss that you paid is the premium 2,500 rupees. So basically, this is how call option and put option also works. Okay, so this was a basic understanding of call options. Next time we will do put options, because it's better not to confuse the two, because people think that buying a call and selling a put, that is not the same thing. Call is totally different, put is totally different. Okay, today we are going to do one or two sums on call option, or mostly the sums come with both the options. So what we will do only the call part today, and tomorrow we will do, or next time we will do the put option. Okay, so let's see one example from our practice manual. I think question 49 is something related. Just let me open it on my computer. Just a minute. Don't get distracted, it's opening slowly. Yep, here it is. Question number 49. Yep. Perfect question for us. Please could you all open to this page? I think it's page 45 of your practice manual. Oh, wait a minute. 45 of chapter 5. I mean, just see where it is basically in chapter 5 of FM. A call and put exists on the same stock, each of which is exercisable at rupees 60. Okay, they now trade for market price of the stock today is 55 rupees. Market price of the call is 9 rupees. Remember, market price of the call means premium of the call that I was talking about, 20 rupees earlier in that example. Okay, and then they've given some info about put. Let's ignore that for now. Calculate the expiration date, cash flow, the investment value, and the net profit. Okay, from there are 4 different: buying one call option, writing one call option, buying one put option, writing one put option. For expiration date, stock prices of rupees 50, rupees 55, rupees 60, rupees 65, or rupees 70. So now what we have here, we have to just calculate, just think of that example that I gave you, simple example of Reliance, what I gave you. We have to just follow those simple steps. Okay, so now first, now you see these 1, 2, 3, 4, they are not part of the same sum. These are different questions. Question 49.1, question 49.2, like that. Okay, so first we are solving question 49.1. Okay, that is buying one call option, buying one call. Okay, so this is exactly same as our example. In fact, you can erase the figures if you want, and just beside that only write our figures. So we see over here that the market price of the stock is 55 rupees. Okay, the current market price is 55 rupees. There is a particular format basically which I want you to follow in this. At the expiration, now remember I told you it became 1000 rupees after 1 month. Now that 1000 is actually this 50, 55, 60, 65 and 70. Okay, so like 1000, 1200, 1400, at different levels we are seeing what is the profit or the gain. Okay, so 50, 55, 60, 65, 70. Okay, so these are the 5 different spot price at expiration. Okay, so the premium is the first thing that we will record. How much is the premium again? That is the market value of the call, I think 9 rupees, is it? Yes, 9 rupees. Okay, this 9 rupees is an outflow, that's why I'm showing it in the brackets. Just a minute. Yeah, minimize. Yeah, see, this is the format I want you to prepare. Here I've written the spot price. If you see 50, 55 in different columns. Okay, and beside that in the description part I've written premium. Okay, so 9 negative for all the different spots. Okay, now let's do one at a time, otherwise you'll get confused. So now take that on 21st November, that is in the future date, the price was 50 rupees. Okay, so what will happen? The price is 50 rupees. The exercise price of the call is what? That we will get in our question. It is clearly written, I believe here. Yep. Yeah, the call input exists on which exercisable at 60 rupees. This is the first line of the question. 60 rupees. Exercise price is 60 rupees. Okay, and the spot price is 50 rupees. So what happens in this case? It is null and void. Okay, the option becomes unexercisable because the option is more expensive than the spot at expiration. Okay, so it becomes out of the money option. Okay, now let's look at an example of the last one. We did the first. Now let's assume that spot on 21st November was 70 rupees. Okay, so this time it becomes in the money. Why? It's a simple formula. If the exercise price is greater than the spot price or the spot at expiration price, then the contract becomes null, because you will go to the market and buy it from there. But if the exercise price is less than the spot at expiration, then of course you will go and you would like to exercise the option, because it is falling cheaper to you. Okay, so now we are seeing the example of the last one, that is 70 rupees. Is it coming properly? No, that is a 50 rupees one. Yeah, 70. I think this one we are going to do 70 rupees, which I've already written. The premium is 9 rupees negative. Okay, so 70 rupees, and let's see now the net profit or the loss from this. Okay, the net profit in this is what? 70 minus 60. Why 60? 60 is the exercise price, 70 is the market price. So 10 rupees is the direct profit that I get. Okay, 10 rupees is the direct profit, and 9 rupees I had paid initially. Remember, the premium I had paid 9 rupees. What is the net profit over here? 1 rupee. 10 rupees is my gain, 9 rupees was my outflow previously. So 10 minus 9, 1. 1 is my net net profit. Okay, and this is 10 rupees is, you can say, my, okay, 10 rupees is the gain from the option. Okay, so similarly you can do as homework the three parts, that is 55, 60 and 65. What will happen in 60 I'll tell you now only, because the exercise price is 60 and the spotted expiration is also 60. It is like going to two different shops. Okay, at more Birla's more showroom you're getting Cadbury for 10 rupees. In outside shop you're getting for 10 rupees. So you're indifferent. So that kind of option is at the money option. Means you can buy it from the Rahul in that example, remember Rahul, or you can buy it from the market directly, because the price is the same. Okay, so this is where we conclude buying a call option. Yeah, now we are going to talk about writing a call option. Okay, writing means what? See, you're buying something, so someone has to sell it, right? Whom you're buying from, that Rahul, he's selling the option to me. Okay, so he's selling the call option to me. That selling is also called as he's writing the option for me. Writing, selling or slash writing option. Now, I'm taking a pause here because this is like a different, is a part of the same concept, but it is slightly new. So I don't want, that you should draw a line in your head that इसके ऊपर ये sums किया, इसके बाद में line blank होना चाहिए. Refresh your memory. Okay. So chalo, let's start now. Now we are doing selling option or writing an option. This I will explain with this example only. Okay. Now Rahul is there, suppose. Rahul sold me for 1000. Rahul sold me the option at 880 rupees option. He got 20 rupees premium, remember? That act of selling me is writing an option, is like an insurance company. The insurance company which sells you the health insurance is actually the person who's writing an option. Okay, something like that. So in our question 49, if you see part 2, that is, you're writing a buy option. They want to know what is the cash flow if you were in place of Rahul, okay, or if you were the insurance company, whatever. So what is the profit or the loss from your this thing? So here we see, again we'll have to write down all 50, 55, 60, 65, 70, horizontally just write it down. Okay, first of all always comes premium. Now premium, 9 rupees, 9 rupees, 9 rupees, yeah, 9 rupees and 9 rupees, yeah. Okay, what is the difference that you spot? The first thing that you spot in this should be that I have not added the 9 rupees in the bracket. Why? Because I am receiving the 9 rupees. Okay, I am Rahul, I am receiving the 9 rupees. The premium is going from his pocket, the person who's buying the option, and is coming into my pocket. Okay, so 9 rupees is my premium. Okay, so now let's say we will look at 50 rupees again first. At 50 rupees, that is after 1 month now. This is the spot at expiration. After 1 month, what happens? The premium is paid on the first day, and after 1 month, what happens now? Let's see. It is 50 rupees. Our exercise price is 60 rupees. Okay. Now, what happened now is this 50 rupees that is there. Okay. It was out of the money option, right? Because that person wouldn't come to me. I am Rahul. This person wouldn't come to me. He will go to the market and buy at cheaper rate of 50 rupees. Why will he buy from me at 60 rupees? Okay. So he's buying from the market at 50 rupees. Okay. So he's not exercising his option. It is out of the money for him. So इसमें मेरा फायदा है क्योंकि I don't have to suffer that loss. I don't have to sell him for 50 rupees when I know the market price is I don't have to sell him the option. I don't have to sell him the share for cheaper rate when I know that in the market it is this thing, right? Because we see here the market price has fallen down, so he will not exercise the option. So in simple terms, my net profit over here will be full 9 rupees. Full 9 rupees. I've circled it. This is my net profit over here. Okay, because the premium जो गया वो गया. It is like health insurance, 2,500. अगर तुम बीमार नहीं पड़ते हो तो उनके पॉकेट में घुस गया वो. Okay, so that is 9 rupees. That is the profit. That is it. This ends here. This is very simple. Writing an option. This ends here. Okay. Now, this is out of the money. Now again we look at the example of our review, that is 70 rupees. If the spotted expiration was 70 rupees, what would happen over here? Just turn your page. Okay. What is loss for the buyer is profit for the seller, and vice versa. Okay. So now you see over here the gain from the option to the buyer was 10 rupees. Okay. This simply becomes a loss for the writer or the seller, you can call him. So 10 rupees is the loss, and the net loss that he makes is 1 rupee on the transaction. Net loss on the option. Okay. Here, this one. You see this 9 rupees? ₹9, 10 rupees is the loss, and net 1 rupee is the loss. Because 9 rupees he received in the advance as premium, 10 rupees he had to pay. In the sense, 10 rupees was his loss because he had to buy at 70 rupees from the market, and he had to sell him at 60 rupees, which is the exercise price. Not always he has to buy. He may be having the stock, but still he could have sold it in the market for 70. He's selling to him at 60 rupees. Why would you want to sell for something cheaper when you know the market price is this much? Okay, so this is -1 loss. Again, like we said, you can do the others 55, 60, 65 at home, following these two formulas. Nothing different in this. For 60 rupees again, it is at the money, so it doesn't matter. So in this case, at 60 rupees he will not exercise the option. It doesn't make sense. Normally we take he will not exercise the option. Okay, even if he exercises, there is no loss to the seller and there is no profit to the buyer. So at 60 rupees, still 9 rupees is his income, right? Because he's not exercising, basically he's not suffering any loss. So 9 rupees is his profit. Okay, this is how we end the call option. Put option we are going to do tomorrow. It has a different concept. And in call option summary, I would like to say call option is what I was going to summarize. I was going to say whether you're the buyer and you're the writer. So these are directly the opposite, like a mirror, it is directly opposite. Call option buyer and call option writer. That is all. Thank you for the lecture. Thank you for listening.